What's up, guys? Your agent Tyler Way Rung, and today I want to talk to you guys about a topic that's near and dear to me because it saves you guys money every month instead of just throwing it away to these giant insurance companies and government corporations. That topic is getting rid of PMI or MIP. They're essentially the same to you in the fact that they don't provide you any benefit, yet they cost you money every month. So you likely have PMI or MIP if you originally bought your home with less than 20% down payment. So these programs are excellent to get you started in a home because they let you buy a property for having very little money down, in some cases 3% or less. But they are bad in the sense that most people buy their home, they fill it up, they start to enjoy the benefits of being a homeowner. They throw that thing on an automatic payment so they never have to worry about a late fee or mailing checks in. I'm very guilty of this as well, but they forget that this minor payment or this minor fee is included in that payment. So I shot a video that I'll link to above kind of talking about the background of PMI or MIP, but this video's focus will be for you to get rid of that and no longer have to pay that again. All right, so if you're curious if you have MIP or PMI or you're just totally unsure, pull out a mortgage statement that you've either got in the mail or go online, log into your account and pull up your latest statement. Now I know these things can be tricky. They have numbers all over them and different line items for different things. The keywords you're looking here for are PMI or mortgage insurance premium, or mortgage insurance, anything that kind of lends to those languages. Now you will have property insurance, and that's very normal, and that provides you a benefit, so it's worthwhile for you to pay that. But anything that has insurance and mortgage on it in the same statement, that's something that you want to get rid of, because that's really, you're buying insurance for the mortgage company's benefit in case you default. So the three normal things you should see on your statement is your principal, interest, and escrow. If you don't have escrow, sometimes it's broken out in property taxes and insurance. So you have 3 or 4 things that should be very normal. If you see a fifth one, and it sounds like mortgage insurance, get rid of it. All right, and here's how you do that. All right, so banks feel safe when they have a 20% equity cushion or a 20% buffer in case things get hairy. They have to take the property back from you and sell it. That's kind of their buffer or safe window. Now, once you have 20% equity, you can request that PMI be taken off of your loan, but you have to initiate this request. Now, MIP, you actually have to refinance out of that and get a brand new loan that does not have MIP on it. But in both cases, I want you to know how to figure out when the time is right to either initiate that or to consider refinancing. And that is to take your mortgage balance. So before, when you went and got that statement, or if you didn't do that, pause me right now and go look up your mortgage statement. Once you have that balance, that final balance that you owe, take that amount and divide it by 0.8. So type that amount in, hit the divide, hit 0.8 equals. Now that amount that you see on your calculator now, that's the minimum amount that your property has to appraise for in order to give the bank a 20% equity position in order for them to remove PMI or MIP. Anything it appraises for above that is good. Anything it appraises for below that is no good. So ideally, you want your house to be significantly more than that or a good chunk more than that. The way to figure out what your house is worth, in this example, since we're trying to get quick and dirty, go out to Zillow, see what Zillow says your house is worth, but more importantly, look at the zone. Don't just look at the Zestimate. Normally they give you a low end and a high end, and try to gauge where your house might be. If you think you're on the line, give me a call. I'd be happy to help kind of look at your situation and see what I think the opinion of value might be from an actual appraiser. But in most cases, people have massive appreciation that they've realized, and they're not even close. Their house would appraise for way more. They're probably sitting on a 60% equity position, and they still are paying this mortgage insurance premium or PMI. So that's who this video is for. You can also do the reverse of that same calculation if you know exactly what your house is for. Maybe a similar one just sold by you, or a similar property has just been appraised and you're aware of the value. Take that value and multiply multiply by 0.8. And if your mortgage balance is less than that, you have more than 20% equity position. In this crazy housing market situation right now, everyone is experiencing a lot of appreciation. So this is a great time to get rid of mortgage insurance premium or PMI if you are still paying for it. And I highly recommend you get rid of it so you're not just throwing money out the window every month. If you actually enjoy throwing money out the window, drop your comment below and I'll give you my number. You can throw it in my window. But I know most people aren't. Most people are trying to build wealth and put themselves in a better financial position. So I hope this helps you do that. At least save you a good chunk of money every month that you're not throwing away. All right, guys. So if this video was helpful at all, your payment back to me could be a simple click on that like button below. I'd be eternally grateful. That just tells YouTube that this content is valuable and others might benefit from seeing it as well. But as always, guys, Tyler Wayron with Keller Williams. We'll catch you next time.